Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Liff, Senior Partner and Head of Private Equity North America at Sun Capital, to discuss which sectors are recession resistant and why having strong operational capabilities is essential for businesses to remain competitive in volatile market environments. Stephen, it's great to have you with us. Welcome to Trade Talks.
Thank you so much for having me.
You got it. How have investors and businesses been impacted by rising interest rates, and what will happen if the Fed continues to raise rates?
Well, that's a great question. Obviously, from a business standpoint, businesses are being impacted. Their borrowing costs are up substantially versus a year ago, and we lived in almost a 0% interest rate environment for 10 years now. So they won't be able to do things like growth capital expenditures, limiting their hiring decisions, their other cash needs, and think about their ongoing borrowing needs. You know, many companies use leverage to fund their net working capital and other business operations. So those are being pinched as the credit environment is very tight. Now, from an investor standpoint, we as private equity firms, need to use leverage. We're leverage buyout people. So we have to think about the borrowing costs, how much leverage we can get, and how that will impact, the companies we buy and the operations going forward. Now, of course, if the Fed keeps raising interest rates, I think that will continue to impact the economy, impact businesses, and they'll be much tighter, and it'll be more of the same. But what we have seen is they have tamed that. They didn't raise rates as much as they were expecting to because some of the banking issues that we've had in the last 2 weeks.
You've been at Sun Capital for more than 20 years, meaning you've operated through 2001, the 2008 recessions. How have you navigated past recessions, and how do you think this one will be different from previous ones?
Yeah, having been here for over 23 years and in leveraged finance prior to that, I've seen my fair share of cycles, good and bad. I think the way we navigate through these kind of periods is just through operational excellence. We are a pioneer in operational private equity, and what that means is we have operators on our payroll. We don't manage companies day to day, but these kind of folks, which have been C-suite executives at companies prior to joining Sun, can really help our management teams navigate the headwinds that we're facing now, whether it's supply chain issues, inflationary issues, talent issues. So going through these type of times is where we actually shine. So it's a great tool for us, and we use what we call Sun Transformation Systems. That's a toolkit, and it revolves around a few different levers that we pull for our companies. It could be growth initiatives, it could be cost containment initiatives, it could be financial reporting and KPI management, it could be talent, team, culture. Those are just a few areas where our operators will help our management teams dig in and find ways to create value.
What sectors do you view as recession resistant, and where do you see the opportunity to create value?
So that's a great question. And since the last global financial crisis in the late 2000s, we have focused on recession resistant businesses in many areas. For example, business and consumer services. If you think about, one of our deals was in the residential HVAC and heating industry. If your heater or air conditioning unit goes down, whether in the Northeast in the winter or Florida in the summer, you're not going to live in 105 degrees in your house in Florida. So you're going to fix it and figure out other ways to save your money. If you look at consumer, whether it's pet, food, the baby space, those are areas where people don't tend to pinch pennies. Similar to healthcare services. If you're really sick, you're going to go to the doctor. Having said that, these are not recession proof. We still have to deal with interest rate hikes. We still have to deal with talent and talent acquisition. We still have to deal with inflation. So, but these fare better in tougher times from what we have seen and the companies that we've bought. And there's great ways to create value. If we buy a HVAC company, for example, when I bought that one in the Northeast, we added 10 companies underneath that platform. So I had multiple weather patterns as opposed to relying on one weather pattern in the Northeast, and really helped a founder-owned business grow. So that's what we're seeing today.
Right. And one thing that's really coming to light is the strength of management teams. Why are operational capabilities more critical than ever for investors like yourself?
Oh, that's a great question, and it's very telling for today. And it's more or less of what I've been talking about. If you think about where we are with high interest rates, inflation, supply chain management, it's such an incredibly competitive global environment, that our companies need to continue to adapt to this, ever-changing environment, especially with rates, supply chain, and whatnot. So for us, having that operational capabilities, we're really able to get in there and help our companies, I think is critical, because when, the economy is so fruitful like it was post the great financial crisis in the late 2000s, it masks a lot of scrapes, bruises, and dents. But in times like these, where you are facing headwinds, you better be operating to the fullest of your capabilities, and you better be nimble.
As a deal maker, what, if anything, excites you about this paradigm shift?
I think, folks like us that are very operationally focused, we're going to fare better in tougher times. We're facing, again, themes of the day: interest rates, inflation, economy, recession. This is where we shine. We can get in there and help founder-owned businesses. We buy a lot of corporate carve-outs. We can help them operationally. And again, I think if you're going to have headwinds facing you, we have to figure out ways to grow. So, this kind of shift will allow us to buy great companies, perhaps at somewhat depressed earnings and or not so wonderful balance sheets. And what does that do for us? That allows us to buy companies at better values, help them operationally. So then when we sell them, we're obviously selling them in a better economy, hopefully in a better credit environment. So we're not only getting, multiple arbitrage on the earnings that we create, but, we're creating a lot more earnings for these companies.
And finally, how do you think private equity returns on the industry will fare given interest rates and the overall health of the economy?
I think in general, private equity returns will come down. I mean, if we think about where we are with this overall interest rate environment, again, it's a leveraged buyout firm. So, some leveraged buyout firms are leveraging their deals 3 to 7 times. So if you're leveraged 6 times and your interest rates are going up 5 to 7%, based on the spread that you're using, you got to cover that. I also find it's going to be more difficult to get the same amount of leverage. So in certain instances, you're going to have to put in more equity, and you're going to get less debt, and that debt's going to be more expensive. So that all impacts, private equity return. Having said that, again, this is where the best will shine and the average investor will fall away, because, we have to find ways to get great returns for our investors. And we will find opportunities in today's environment to buy companies more cheaply, to enhance their operations, and again, create that not only earnings arbitrage, but multiple arbitrage when we're selling businesses. So like anything, I think we'll have an opportunity to buy low and hopefully sell high as we really do operational wonders for some of these companies. But it is going to be a challenging environment, and I think this environment's going to last for a long period of time.
All right, Stephen, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you for having me.